battery swapping stations, where they hold exclusive advertising rights, creating a blend of green mobility infrastructure and OOH media. With this, I conclude the company overview, and I would like to hand over to Mr. Raghu Khanna, Chairman and Managing Director. Over to you,
Hi, good morning, everyone. So we'll give you a brief presentation about our company. So we are basically a asset-light monetizing model where we create assets, and these assets are monetized through advertising through various advertisers. And I request Angela if you can just start with the presentation. So Castrata started in 2009 with the focus of advertising on the cars. So we're the first one to start with the cars of Meru and Mega cabs. That was the year 16 years back when we started. And the concept was because there was a huge change in public transport at that time, also where India was seeing a Kali Pili modification to a radio taxi, which was the first time in India. And we started approaching brands and we started monetizing that. That is why the name was Cashshot, right? And that is how we started the business. Today, we happen to have various other inventories in our fleet. We have got electric buses because that is another change which is happening now in the ecosystem of public transport. New EV buses are coming. We've got charging station, which happens to be part of the public transport network, which is helping the buses and the taxis to get charged. We have about 65 digital screens, and we have around 250 bicycle shelters in Delhi and in Chandigarh. And we have executed about 5,000 plus campaigns. And our main motive is to work as a concept house and give an end-to-end solution to the clients, where we do a full spectrum advertising solutions now from for all the clients. Next slide, please. So this has been our journey. So we started in 2009. We were the first one to advertise on the taxis. We were the first one to trademark and start working with O Electra and Green Cell, which have around 1,000 plus electric buses in across India. And the whole idea is to monetize the sustainable media because most of the brands are now, apart from visible branding, they need responsible branding also. And there's a huge push from the government side also to have better EV infrastructure in terms of EV charging stations, EV buses, EV taxis. So we are portraying that particular media for all the brands who are ESG. These medias are ESG compliant. Next. So our business is divided into four parts. One is the transit media part, which takes care from an auto rickshaw to an airlines. So all the on the move media. Then we have got the digital OH part and the traditional out of home part, which take care of the digital programmatic out of home. Then we have a division which takes care of the BTL and print and ATL division, which takes care of the events also, and the regular TV and print ads. So we have a strategy team, we have a media buying team, we have a creative team, and we have a campaign execution team, which gives a 360-degree support to all the clients. So our model is divided into two parts. One is the exclusive media. Exclusive media are the buses which we are owning. So right now we have 1,800 buses. And one is the trade media, which is the media which we trade for our clients. Our margins are higher in the exclusive media, and that is where the major working capital requirement is there. In trade media, we trade the media for clients' requirement. That is more like a media buying part, and exclusive media is more of a media selling part. So that is both specialties are there. Today, about 30-35% of the revenue is coming from the exclusive media, and 70-75% is coming from the trade media. In exclusive media, the best part is once we have that particular range, a better revenue stream, our PAT margin increases because our costs are fixed in the exclusive media and our margins are higher in the exclusive media. So what sets us apart, specialized in transit media solutions, we have everything in-house from creative designing to the execution part. And we are now moving towards more of a tech orientation, which gives a one-stop solution to most of the brands. Second, next slide. So the key moat is since we are an asset-light model, we have a lot of opportunity of expansion, and there's a huge change in terms of supply and demand both. So in terms of demand, the clients want the new medium, they want new buses, they want a new infrastructure where the people are conglomerating or people are using, and most of the brands want to be present there. And in terms of supply side, a lot of government associations and a lot of PPP partnerships are happening from the government side. So new buses are coming in and new infrastructure is coming in. So both of them are sorted and most of them are in a PPP model. So it is an asset-light model for us. So we don't have to invest on buying the bus or anything, buying the charging station. There are companies which are already doing this. We are just approaching them and offering ancillary revenue options for them. So this helps us improve our top line and help us scale to different geographies very quickly. In comparison to the traditional outdoor, which are more like an asset heavy model where they have to buy the stuff, erupt that stuff, and it is a time consuming capitalized process. And the idea is using this technology, we are making a win-win combination to bring the tech also to give that brands the kind of a leverage in terms of where the buses are moving, giving them the heat map report, and making more tech oriented for the brands to actually see where the money and what is the kind of an ROI they get after investment with Cash or Drive. So this is a geographical breakup. Next. So these are some of the campaigns we have worked with brands like McDonald's, Uniqlo, Flexbus, IKEA, PepsiCo, and these are various formats where we've executed these campaigns. So if I talk about outdoor advertising, they have been consistently growing. It has not been impacted much by the digital as print and TV has been. So there's a CAGR of about 6% throughout. And in terms of supply also, I'll show you some numbers in the next slide, please. So there is a 30% CAGR of EV infrastructure. That is the number of cars, number of EV stations, the number of EV buses, which have been increasing year on year in India. Next. Next. So I'll hand over this stage to Mr. Rajat, our CFO, to brief up about how our H1 results were year-on-year comparison and the PAT results. Rajat, over to you.
Thank you, Raghu. So as Raghu rightly mentioned about the contribution, we have gone up to exclusive media from the contribution has gone up from the traditional media to the exclusive media. So these are the few KPIs for the half yearly ending on 30th September 2025. So revenue has gone up to 77.9 crores in the half year ending at 30th September 25, has gone up by 22% as compared to last year for the same half year. And as the contribution of exclusive media has gone up, the EBITDA margin has also gone up to 17.2%. So there is a growth of 1.2 basis point. PBT and PAT margin are also in line with growing up. EPS has also gone up. Move on to next slide, please. So segment-wise also, digital marketing. So we are not only into cap branding or transit media. We're doing outdoor media, transit media, print media, and digital also. Sector-wise also, we are not focusing only on the private clients. We are doing the mixes between the government and non-government clients. And we have also the geographical presentation all over India. Next. So these are the numbers for the half year ending on September 26. So if we compare year on year, the top line has gone up to 77.8 crores from 63 crores last year. The growth is around 22%. So overall in the advertising industry, generally the first half is the lean period as compared to the second half because the festivals and all are there. And the PAT margin has also gone up. The EBITDA margin has also gone up because the contribution from the exclusive media has gone up. Next slide, please. So these are the last 3 year financial statements. So we are following the growth margin, growth trajectory year on year basis. Next slide, please. So this is the financial position. The shareholder funds have gone up to more than 100 crores in this financial year. Next slide, please. So the return on equity is around 44%. Margins have gone up as we referred in the last slides. So we are maintaining the healthy current ratio as well. That we are the debt-free company. Next slide, please. So I'll hand over to take you through the way forward of the company to Raghu.
Thank you, Rajat, for the financial insight. The idea of growth towards us, because we'll be integrating all the tech part with the AI, our sales process will be AI driven. The ROI or proof of performance will be all tech driven. That gives us a technology led efficiency, which will help us in scaling quite quickly in comparison to the traditional media companies. We'll be setting up an in-house printing setup which takes care of the production with the state-of-art machinery which are there available in the market today in comparison what is happening in the West. And we'll be taking more long-term secure rights for the media, which will help us build this company to a different level in years to come with the longevity of the contracts and development of media in the newer cities. Because there's a lot of geographical expansion which is happening in terms of the EV buses which are coming in new cities. Next. So the investment thesis is we are targeting complete the new infrastructure which is coming in the public transport, be it the buses, bus shelters, trains, metros. These are all our target audience, and these are all comes under transit media. So we'll be focusing on that particular thing at this point of time. Along with that, we will be having an exclusive model and trading model both working together, and we see huge change of profitability in the exclusive media. In terms of financial growth, we have seen about a consistent CAGR growth about 30-35% in last 3 financial years. And we hope we'll have something similar in going forward. And geographical spreads, right now we are more concentrated in the north and we are looking for expansions in the south as well. And that will add to our top line and bottom line both. Next slide. These are some of our clients who have been strong marquee clients with us, working more than 10 years, like Wings 11 Punjab, Borges Olive Oil, Flixbus, Korean Air. So we have clients from various genre, from FMCG, from airlines, from white goods, like Mitsubishi Electric. So we are not a segment dependent company, and we have clients coming from various segments. Next. These are some of the awards which we recently got for a lot of our campaigns. So we've been working with Zoho, we're working with Kevin Care, and these are the Business World Awards we received. Thank you so much for your valuable time. Thank you, Angela, and thank you, Rajat.
Thank you, sir. So participants, the floor is now open for Q&A. Kindly raise your hand or you can drop your questions in the chat box. So we have first question from Mr. Keshav. Yes, Mr. Keshav, you can go ahead and ask your question.
So basically, Raghu, I'm trying to understand that I couldn't understand the difference between our exclusive media and the traditional or the basically trading media. I couldn't really get the point. What's the difference? And the second thing is that what is stopping the fleet owners from directly doing tie up with the advertisement party? I mean, why do they need an intermediary like us to basically be in between?
Yeah, very interesting question, sir. So first, I'll give you an answer for the second question first. This will get connected to the first question. So in terms of the fleet owners, because brands like to deal with one-stop solution. So they need multiple, and these fleet owners, they are smaller fleet owners and multiple cities. And then it is easier for a brand to work with one agency and one fleet owner. And since fleet owners' main business is running the taxis or running the buses, so they don't have a media sale expertise, and that has been there since last 16 years. That is what we have seen when Meru cabs were there or Mega cabs were there. So it is an ancillary business, and client wants a one-stop solution. He wants taxis also from one person. He wants buses also from one person. He wants auto rickshaws also and hoardings also from one person. So that is where that part doesn't come into play, that they start their own workability model. And in terms, you need execution strength also to execute, like the creative team and the installation team. So there are a lot of things which are required. It is not just the sales part which is required to just execute the campaign. That answers your second question. And with this, since it's a one-stop solution thing, that is where the trade media and exclusive media comes. So exclusive media is what I've underwritten for 5 years. So I paid, suppose in Delhi, I've got buses. I paid those buses for 5 years. And if now the client wants some hoardings also along with that in Delhi, because all the client want one-stop solution. So I trade those hoardings from who are the actual media owners. And suppose there's a 100 rupees spend which a client will make. So I'll give 30 rupees to my buses and 70 rupees has to be taken from the market, because only buses will not suffice for the media plan. So they will have other options also where they need at the airport, at the toll stations, at the premium location. So those we have to trade and buy it from different vendors. So that is why the differences from trade media and the exclusive media. And like in the second question, I answered it's just one-stop solution the client wants, and that is why we have to enter into trade media also.
Right. So Raghu, basically, do we now, for example, if there is a fleet owner, let's say Uber, and we have a
Yeah.
tie-up with Uber to advertise on their taxis. So basically, how do we pay them? Do we pay them on a monthly basis, some kind of a annuity
Yeah,
or rental
we
kind of?
pay them on a monthly basis some kind of an MG.
Okay. So basically, there is no upfront cost that is capitalized on our balance sheet.
No, that is not. So that is where the difference between the traditional outdoor and this outdoor is. So in traditional outdoor, you have to buy the iron structures, you have to put the lights, you have to capitalize that particular cost of making a hoarding, which comes to right one and a half crore rupees, depending on the aesthetic sense of the hoarding. So you have to capitalize that cost. Over here, though, capitalized cost comes in a balance sheet.
Right. So now, Raghu, about the EV charging part, I couldn't understand. I mean, are we planning to own and set up EV charging stations on our
No,
own,
no, 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 no. We are not doing that. There is a company which does that, and we are just monetizing that space. So the capital cost comes to that company. We are just creating the EV, the advertising infrastructure on that EV station, and we work. We sell that
great.
in asset
So
light
now,
model.
yeah, that's great, Raghu. And now the printing part, you mentioned in your presentation that we are setting up our own printing house. So, I mean, why can't we just source it from vendors?
We are doing it with vendors, but there is a quality control. There are few things where you need urgency. You need a specific quality of vinyl. You need a specific quality of print which is there. So you need that flexibility, and that is where the self setup helps.
So Raghu, now what's our debtor days and what's our creditors days? And can't we match both of them that once we get the fund from, once we get paid from our customers, then we pass on those proceeds to basically the fleet owners, etc. So that basically there is no working capital of the company. Then we'll be truly asset
So
light.
see, that is the gap now. So when you are underwriting a media, you want exclusivity, you have to pay them in advance. If you're just trading the media, you can do that. So if you're trading and you don't want exclusivity, you can do that. That will be a complete asset light. That is a complete trading model. But the margins are very less in that case. You have market competition, you have lesser margins, so there is a lot of flip side to it. That is why the company started the exclusive media division about 4 years back. So we were at 3 crore rupees in financial year 22. And last year, 25, we were at 22 crore rupees in exclusive media. And all this adds to our bottom line. So once you have exclusive media, you can govern the rates. You can actually have the market authority of the rates because that media is only owned by you. So there is no one
So
else who
Raghu,
can sell that media.
okay, so Raghu, just to recap, the exclusive media, we have to pay something upfront and book the space, and
Yeah.
then there is a monthly rental kind of thing that we need to
Yes.
pay.
Yes. Yes.
So the upfront payment that we do, where does that show in our balance sheet?
Rajat, if you can answer this in exact
So,
chronology.
so we, Keshavji, we don't have to pay any upfront fees. So in some cases, there are performance guarantees, which are refundable security deposits in the form of bank guarantees. And all the expenses we have to pay monthly. So these are the rental expenses. So there is no capital cost.
Okay, so basically it's a kind of a tie-up that for let's say 5 years that we will be exclusive
Right.
and the rate is predetermined for the
Yes.
5-year period.
Yes.
Okay. And whereas in the trading media, how does it work?
So in case of trading media, so there is some another media owner like us. So in case of exclusive, we are directly dealing with the clients. In case of trade media, we are dealing with the clients, and our vendors are the another media owner, another cash holder.
Okay, okay, got it, got it. Thank you, Raghu. Thank you, Rajat. Thanks for the clarification. Best of luck.
Oh, thank you.
Thank you, sir. Sir, we have next question from Mr. Murlidhar Pooja. Yes, Mr. Murlidhar, you can go ahead and ask your question.
Yeah. Can you hear me now? I think, yeah. Okay.
Yes, you can. We can hear you.
Yeah. I think my question to Raghu. I saw from the presentation there is a page, what sets us apart, and also I think somewhere you even presented about what you call the modes. So this is relating to that. My question. It's like there is no kind of any innovation or patents kind of thing in this area, right?
Yeah.
So like how can we distinguish ourselves as a like maybe superior from competition? So how are you projecting that so that we can show some edge from the competition and get better business?
So there are two things in this. One is the media type. That innovative media type or a differentiation is very critical. So we are just focused on transit and public transport unit. So right now, 95% of the people are spending time online or on the road. So we are just targeting that particular segment which is on the road, and that sets us apart. And we are very focused in our workability, where we have to work with the clients who are using these formats of advertising in our media. So that is where the exclusivity will set us apart, and the media type. So you can't have a patent in this, but you can have exclusive right to a right media. If there is a particular media which is like airports, if you have the rights of the airport, people will only take it from you, and that is how you beat your competitor. When there is a pitch to a client and you say that I have an airport and the competition doesn't have, so you get that edge to enter into that client.
Yeah, but anybody can, get that right later time also. Like for example, next year, after a year or sometime, maybe, someone can
That is where the
pay
moat is.
better price
We
and
are
then they can acquire
currently
that area, right?
currently we are present in 25 cities. So in last 16 years, that is what we have built up. And getting brands to execute a multi-city campaign, it will take for anyone, because outdoor has been a very localized market. There is no national players. There are very few national players which are there. So brands need agency which have national presence.
Okay, so you mean to say actually the competition is very low?
The competition is very low, plus your speed, because you have to be one, the type of media, second, geographical expansion is equally important in this.
Yeah, yeah. Okay, great. Thanks. Yeah.
Okay, thank you, sir. So we have next question from Mr. Madhur Rathi. Yes, Mr. Madhur, you can go ahead and ask your question.
Sir, so I wanted to understand what is the margin differential that we earn on our exclusive media assets and on the traditional or the trading segment?
There are almost there's a difference of 2x. It's almost double.
20%
Inclusive.
EBITDA, 20% EBITDA level?
Yeah.
Got it. Sir, so if I consider, sir, 26.5 crores that we did from the exclusive media, sir, what assets are these? Are these totally the bus contracts that we have or the digital out of
Bus, digital, everything inclusive. All the media assets which we own.
got it. Competitor in this segment. Hello.
Yeah.
Yes.
Sir, so is Signpost India a competitor in this transit media and the digital out of the home segment?
Yeah, they are our competitors, but it is not an apple-to-apple comparison. They are into more of traditional media. They're into a asset-heavy model.
Got it. Sir, so if I were to consider, sir, what is the lease outgo or the rental expenses that we need to pay on an annual basis for the exclusive media business?
So that varies. That totally varies on media to media and state to state.
No, sir, on an overall basis. So out of the
Even
total contract.
if I talk about cost of service, so if you see, we have approximately 30% gap in the sale price and the gross profits. So that can be
30%.
calculated. Yeah, 30% is almost the gross profit in that.
30% is the gross profit. And sir, how much percentage would be going to the lease or the rental out of the rest 70%?
That is the major cost. About I think around 50% would be around 33 to 40% would be on the lease and rental part.
33 to 40%. Got it. And sir, what would be the occupancy level of these exclusive asset currently?
See, it's a very seasonal business. So our H2s are heavy, our H1s are a little low. So if I
Right.
talk about a current occupancy on average is about 60%.
And sir, what was it in FY25?
It was about 45%.
Okay, 45. Sir, so we can basically on this segment, is it a fair possibility?
I beg your pardon?
Sir, can we do a 40 crore revenue from this segment?
Yeah, that is a very much possibility. Correct.
Got it. Sir, just a few questions, sir. So going forward, where do we see the exclusive media segment as a percentage of our revenue share increasing? Sir, can we expect it to be 50% of our revenue in the next 3 to 5 years?
We are planning to work towards that.
Okay. And sir, how do we bid for contracts? What is the IRR or payback that we expect before bidding for any exclusive media contracts?
So these are normal tenders that we have to bid.
Right.
Yeah.
Sir, so do we consider any minimum threshold of payback period before doing any of the
See, usual tender size is about 5 years because
5 years?
it's an asset-light model, so it is usually 5 years.
5
And
years payback.
yeah, and we expect to get a break even in the first year itself.
Okay, first year break even. Got it. And sir, just a final question, sir. So, what is the average current contract life or the timeline that we have on hand for these contracts?
3 years, 3.5 years.
3.5 years.
Yes.
So we would require to bid for these contracts again after 3.5 years?
Yes, after 2027, 27, 28.
And sir, do we have any renewal or the first right to refusal, some kind of those clauses in these contracts or no?
First right of refusal during the tenure, in case that particular city has additional buses, then we have the first right of refusal.
Not on the renewal.
Not on the.
Got it. So is it I consume that this is a 10% EBITDA margin business. Sir, so where do we see this business with the in-house printing? Where do we see the margins of this business going? And on the revenue front, sir, where do we see this business scaling maybe over the next 2 to 3 years?
See, margin front, our cost would improve in terms of if we have our own printing setup, and that will add to our PAT margins as well as that will add to our top line also.
Okay.
And in terms of tech investment and in terms of other investments, we can see that can actually give a higher ROI in terms of client visibility, and clients can start spending more.
Got it. Sir, that was from my sir. Thank you so much and all the best.
Thank you. Thank you so much.
Thank you, sir. Sir, I think Mr. Keshav has a few more questions. Yes, Mr. Keshav, you can go ahead and ask your question.
So, Raghu, what is the capex required in the printing house? And second thing is that, I mean, whatever fixed cost will be there to run that printing setup, is that enough? Because, I mean, do we really have that much of a demand in-house to keep that printing press occupied and cover the fixed cost?
Yeah, it is there. So about 6 crores is the kind of investment we're looking at, and there's a huge requirement which keeps on coming because that is the need along with the sale.
So now, Raghu, companies like Signpost and Bright Outdoor Media, Times Outdoor Media, so all of these people aren't they also in this space that we are?
Yeah, they are into the same space, correct?
Okay, so then what is our right to win? Where do we score above them, or is it just comes down to the most aggressive L1 kind of thing?
So that is one part. The larger media assets you have, you become better L1 because when you have the ownership and you're not trading more, because everyone cannot have the ownership, right? So Times cannot be present in 25 cities. Times would have major pockets like Signpost and Bright are majorly Maharashtra based, right? So if there is a bidding which is happening in Delhi and Maharashtra, so we are equally placed because we have media in Delhi, they have media in Maharashtra. And if we have additional media in Punjab, for example, then we get an edge because we have to be L1. So
So now,
someone who has more media in terms of geographical reach, that is one, and more type of media.
so Raghu, now basically, if what kind of sustainable margins should the investors look for, basically?
Uh, I don't understand, sir.
No, no. So what is the steady state operating profit margin in our business or EBITDA margin that your shareholders can expect going forward?
I think Rajat would be able to answer this better, sir.
Yeah. So, if you'll see from last 3 financial year, our EBITDA margin has gone up from 12% to right now in the last first half year of this financial year has gone up to 17.28%. So, as the contribution from exclusive media will go up, the margins will, keep on improving. So we are targeting a growth, every time in the EBITDA margin. So I think at least 17 to 18% it will be there.
No, so now the concern is that going forward, if competition intensifies, so we can get squeezed that basically, let's say Uber, if other outdoor this thing, they also compete aggressively. So basically, the rates might go up. I mean, let's say for Uber, and on the other hand, the advertisers they might, so basically we can get squeezed from both the sides, you see, depending upon how aggressive the competition is.
So, Keshav ji, all other outdoor companies like Times Outdoor or Signpost or Bright, they are more into traditional outdoor assets rather than transit segment. So they are into everything like, airports, metro stations, all the holdings, public utilities, and all the capital intensive models. But we are focused on only transit media, and we don't have any capital, and we have the expertise. And even in the government tenders for the buses, and so there are the entry barriers, and we are the first one in the country to start this business of wrapping. So we have the expertise, we have the presence all over India, as Raghu has rightly mentioned, around 22 states we are there. So that has the edge, and we have the credentials. So all the government contracts from the BEST or maybe DTC or any bus transport authority for the bus rides, you need to have some credentials, at least 4 5 years of experience of handling all these businesses. So we have that edge. So in case of government contracts, there are entry barriers into this tenders.
And what about the payment cycle in the government business? I in your presentation, I could see that 40% of our H1 revenue came from government entities. So what is the receivable cycle over there?
90 to 120 days in case of government
Okay.
rights.
Okay. So, and now finally, Raghu, as per your best judgment, how deep have we penetrated? Like, I mean, is now the low-hanging fruit we have already done, and going forward, as we penetrate tier 2, tier 3 cities, that business will come at a higher cost, or do you believe there is a lot of runway ahead? So basically, what is the constraint in your growth? Is working capital a constraint?
Yes, sir. It's a working capital which is the main part because the more media we have and the more media we underwrite, the more media we take exclusive, the better it is in terms of sellability.
So now the funds that you have from the IPO, so with those funds, like what kind of top line you think you are fully funded to achieve?
So you can do the reverse maths, I guess, where we have I'd say about 33 crores is there for the working capital, and we have a credit cycle of about 120 days, that are the working days. So we can actually see the reverse cycle accordingly.
Right. And to the first part of the question, Raghu, that I mean, have we got the low-hanging fruit, or is there still room to grow? And if so, at what rate can we grow? And will the tier two, tier three business come at a higher cost?
So tier 2, tier 3 business will not come at a higher cost.
Okay.
It will not come at the higher cost. And in terms of because what is happening right now, there is a constraint in the supply also. The buses are also getting delivered. The new infrastructure is also in the making.
So
it will not,
basically,
yeah.
so if we assume that whatever buses are there, whatever private fleets and government fleet, whatever is operated by fleet operators and not the single driver operator, so what percentage of those buses are we already advertised?
So we are only
What is the
advertising on those
penetration?
buses. We are just advertising on those buses only.
On which bus?
Fleet owner buses, like buses which are owned by Olectra, buses which are owned by Green Cell, not the
Right.
individual driver buses.
Yes, yes, I got that. So basically, what is the penetration?
So if I talk about the penetration, it would be about 20% right now.
Okay. And out of that, so basically in India, whatever buses are owned by fleet owners, multiple
See,
buses.
now I'll tell you, sorry to interject. Now the whole methodology is changing. Earlier, what used to happen, there used to be fleet operators. They used to buy the bus from Tata, Ashoka Leyland, and they used to ply those buses, or the government used to buy, right? Now with the EV coming into play, that the small bus people, that model is unsustainable to buy a bus of 2 crore rupees. So what the government has given is a FAME 2, FAME 3 option where the manufacturers get the subsidy and they are becoming the bus operators. So we are tied up with the manufacturers directly in that case.
Right. So, I mean, how much is our market? Say, let's take EV buses to begin with. Out of whatever EV buses are plying on Indian roads today, what percentage of business is market share is with us?
About 20%, so that's what I said. There are about 8,000 EV buses right now in India. 7,000 to 8,000 buses. And
So
out of
out
that,
of
about
those,
2,000 buses are there with us.
okay, 2000, and the rest are with whom?
So rest are segregated with smaller players. Like Maharashtra, there's another player like Signpost is there in Maharashtra. All the best buses are with Signpost. There's another player in South. So this is segmented. It is not just one player has those remaining buses. So I'll say, for example, Signpost would have 40% of that bus. We will have 20%. And the rest 40% will be split among other 4-5 players.
So, Raghu, I'm not able to understand in that case, going forward, how can we be confident about 17-18% margin? Because you see, competition is not in our hand. If tomorrow Signpost starts bidding aggressively, and if he goes to our advertisers and says ki boss, I will do the same work in less price, and goes to let's say Olectra and says ki I will pay you more than what we are paying, cash your drive is paying. So in which case we will have either we let go of that business or we match the most aggressive player. So I mean, how are you confident about the margins in that case?
See, the margins are totally dependent on the city where you are in. Okay. And the idea of margins come when you have monopoly. So it is not that easy for anyone to enter into a territory. Outdoor has been a very difficult business. You can't see a south player coming to north and bidding for tenders. And same goes for a north guy going to west. So this has been a very localized and a legacy business all throughout. So getting the tender, getting the assets on record is one thing, then selling is another thing. And that gives us an edge because we are just focused on transit media. Signpost is focused on 10 different things. They have 10 different things to sell before this comes. And since there is no focused company which is doing that, for example, if I talk about Bright is focused primarily on in Bombay market. So if there is a tender in Delhi, they will not bid for that. In case Signpost bids for that, that will be the last priority for them because they have 10 other different things. Our main focus is buses. And once we have Delhi buses, that will be an exclusivity that margins will remain there for next 5 years. If a client need Delhi bus, he has to take it from us. Whether signpost undercuts our bus, anything, there will be no new buses which will be coming to Delhi. So only the government buses, there cannot be another bus coming from Maharashtra to Delhi, right? So it will be just a Delhi bus which will be there.
Right, I get that at least for the duration of the exclusivity contract, we are comfortable. So now, Raghu, like the example you gave with EV buses, out of 8,000 buses, we have roughly whatever 2,000 or so EV buses. What about the traditional state transport corporation buses, the red bus kind of
We are
thing?
taking that also. In Punjab, we have those buses. We have 500 such buses in Punjab. We have got 150 buses of Rajasthan, which are the normal ICE buses.
So, Raghu, which states are we not present in? In which business? I mean, let's say Jharkhand, Bihar,
Yeah, we are
Madhya
not present
Pradesh.
in those. We are not present in East. We are not present in Central India and in South India.
So, I mean, is someone else doing that business, or those
The
buses
buses,
are
there are two cases, two scenarios. Someone else is doing this business. And second scenario, the tenders have not come in.
okay? Okay. So basically, now EV buses and some government buses. Apart from that, EV stations are there. So basically, these two are our main business drivers.
Yeah.
Okay, great, Raghu. Thank you very much.
Thank you, sir. So we have some questions in the chat box. So first question is you mentioned exclusive media can deliver 2x trading margins versus non-exclusive inventory. Can you quantify this margin differential today and explain how much of the FY26 margin improvement is realistically driven by the mix versus operating leverage?
Yeah, there's a 2x difference, but that is a differential which is there right now. And the margin improvement will improve once we have more of the exclusive media because we have higher margins in that. So we have seen a consistent growth in the trade media and we have exponential growth in the traditional media, in the exclusive media. So that margins will improve once the exclusive media percentage improves, which is right now at 30-35%.
Okay, thank you, sir. Next question we have from Mr. Anand. He's asking, do you any differentiated or unique measurement or KPI of ROI generated by customers on their marketing spend done through you? Also, how do you differentiate from the unorganized players and why the customers prefer your company as a preferred vendor against the competitor?
So yeah, the unique measurement, we are creating a tool for that, which will give that particular tool to the brands. And we will have an idea that how it needs to be tackled on. And secondly, if I talk about differentiate from unorganized players, because we give an end-to-end solution, we have multiple cities. So that differentiates us from the unorganized player. Why do customer prefer our company to preferred vendor against the competitors? Because of these two reasons only. That multi-city presence, end-to-end solutions, and the other offerings what we have.
Thank you, sir. Next question is, does the EV charging add
Yes, it
vertical?
does come under exclusive media.
Okay, thank you, sir. So we have next question from Mr. Mohammed. He's asking on the litigation and contingent liability side. As per the DRHP, the total contingent liabilities were around rupees 10 crore, which is a fairly material amount. Could the management please share an update on how this has evolved post IPO? And have there been any resolutions, settlement, or favorable developments since then, or do these matters largely remain at the same stage?
They are largely at the same stage post IPO. These are long-term cases, and this will take a little bit of time to resolve. So that is there. And the investors should not think about the potential cash flow risk because these are litigation matters and we are very strong over the cases right now. So I don't see any potential cash outflow risk coming on to us.
Also, continuation on his first question, he's asking also how should investors think about the potential cash outflow risk from these litigations over the medium term?
See, these will only be contingent liabilities once we have some ruling against us, and then only there can be a positive thing where we can actually. But we have good cash reserve. We have about 28 crores cash reserve, so which is fairly larger cash reserves than the kind of contingent liability we have. We overpower that. Rajat, if you can put in some more numbers on this, that would be really nice.
So out of these 10 crores, there are the contingent liabilities also includes the bank guarantees, which we have given as a performance guarantee to various government authorities for the tenders. So, and in all the cases, we are very strong, and these are long-term cases which are still pending, and we are following up on those cases. So I think this we have already figured out and managed and also calculated during our risks. So there is no major cash outflow right now. Yeah.
Thank you, sir. Sir, second question, Mr. Mohammed has, as the company looks to acquire exclusive rights in the EV media segment, could you help us understand the commercial viability of these rights?
So it's a EV charging station. It is again on the exclusive format where we pay 100 rupees and we try to sell that for 300 rupees. So this comes into that particular segment of area. And these are more meaningful because these are long-term contracts. The EV charging station contracts are for 10 years.
Okay, and he's asking also, are EV exclusive rights meaningfully more expensive to acquire compared to traditional non-EV media rights, or are they broadly comparable at the underwriting stage?
They are broadly comparable at the underwriting stage.
Okay. His continuation to that question is, additionally, from a monetization standpoint, is there a pricing or margin differential when we sell EV exclusive advertising solutions versus non-EV or traditional offerings, and how does this makes impact overall margins and return on capital for the company?
See, currently, we are not seeing a lot of difference in terms of monetization standpoint. But yes, there is a marginal difference because these are new media which are in comparison to the additional non-EV or traditional offerings which are there. Because those things are old now. So every client, like a human psychology, they want to have something new. That is where the differentiation is right now. And with time, when a lot of things will be spent on the EV segment only. For example, there are new EV cars which are coming into India, new EV, your two-wheelers are coming into India, new battery technology is coming into India. They will advertise only on these charging stations because that is the most apt media for them. They will not go for traditional. That is where the huge spend will come to us because there's a huge change which is happening in the green energy segment. So we would really see in times to come in next 1 or 2 years, huge differential in terms of margin to advertise because then it will be exclusive and they will want this media only.
Thank you, sir. So participants, due to time constraint, we will be taking two to three more questions. So we have next question from Mr. Atar Said. Yes, Mr. You can go ahead and ask your question. Mr. Atar?
Hello, am I audible?
Yes, you're audible. Yes, Mr. Atar, you can go
Hello.
ahead and ask
Yeah.
your question.
Sir, I have one question only. Just wanted to know, like, what is the rationale behind increasing our share from the government? Like, usually businesses try to reduce their share from the government but, and try to increase their non-government revenue. But we are focusing more on government. So, what is the rationale behind this? Because our receivable days is quite higher in this government business. So, can you please elaborate more on this?
No, it is not a conscious decision to improve on the government. It is just we have the media which are open and the media which is for a mass consumption. So a lot of government brands take it. So because the schemes they have to go to various locations because bus travels all across. So we get a lot of queries from the government. It is not a very conscious decision that we have to do major government or non-government. So we don't have that bias. And in terms of now, if I see, we work with a lot of state governments, we don't see much difference in terms of cash flow issues. And we get payments on time, and all the paperwork and everything has to be immaculate. That is where the revenues are. And we don't see any rate issues in the government because our rates are already approved by the government.
Okay, sir. Thank you. Thank you so much.
Thank you, sir. Yes, Mr. Madhurati.
Right. Sir, thank you for the opportunity once again. Sir, what is the current order pipeline that we have for these exclusive assets that we are bidding for?
So we don't have an order pipeline system. We do on a retail basis. It's whenever we have a campaign, we sell that media.
So, I'm trying to understand. Sir, so Signpost India recently said that they have got a Bangalore metro contract worth for the next 7-8 years. They'll be try to generate a revenue of 700-800 crore.
Correct.
Many contracts, or what is the amount of contracts that we are bidding for currently?
So we will be bidding about the working capital amount.
So that would be 33 crore. Closer to 100 crores.
Yeah.
Got it. Sir, also, sir, our receivables have increased by 50% between FY25 end and H1 FY26, but our revenue is stagnant on a 6-month basis of H2 and H1. So why is that? So why is there is so much increase in our receivables?
Rajat, if you can.
So, Madhurji, generally, in advertising business, we get the payments, more collection in the last quarter of the financial year. So that is why the FY25 you're seeing receivable at a less number. But generally in case of government business or the private business, generally the collections are higher in the last quarter.
Got it. And so just a final question from mine, sir, on the exclusive media, right now we are at a 20% margin currently. And sir, if I understand that if our occupancy goes up, is it fair to assume that our margins will increase maybe from 20% to 25-30% levels?
Sir, I did not understand your question.
Hello?
Yeah, I did not understand your question, sir.
Sir, so I'm trying to understand, sir, we are currently operating at a 60-65% occupancy levels of these
Yes.
exclusive assets.
Yeah.
So as and when it goes to 80-90%, can we expect the EBITDA margin to
Yes.
improve?
Yes, for
Because
sure, because our costing remains the same. So that will
Right.
improve drastically, that will improve.
Right.
Thank you, sir. Sir, due to time constraint, we have to end this meeting now. So can we conclude this meeting?
Good to go from my side.
So thank you everyone for your time and participation. If there are any further questions, you can reach out to us at corporateaccess@kirinadvisors.com.
On behalf of the Validator team, I thank the management, all the participants for joining the event. Thank you.
Thank you.
Thank you.
Thank you, sir.